Hello, I'm Rob Matheson. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, getting more bang for your buck. The dollar's been on the up in 2022. What's next for the greenback? Also this week, gold hasn't been doing so well this year, but could now be the perfect time for investors to pile back in. Questions over cryptic crypto. Prices have been sliding all year. We're going to look at what's next for these intangible assets as the industry struggles to regain trust. Now, the US dollar is stronger now than it's been for 2 decades. That's because of the Federal Reserve. When the central bank raises interest rates, it makes the greenback more appealing to investors around the globe. But the global economy is teetering on a cliff edge. And as fears mount of a worldwide recession, dollars are seen as a safe place to hold your money. Now, this shows how the dollar's been doing against nearly all other G20 economies. Overall, the picture seems pretty good. The greenback rallied around 19% in 2022. The dollar is still strong, even though the US economy has been weakened by the COVID pandemic and a threatening global recession. It's been going up thanks to aggressive rate hikes by the Federal Reserve, economic issues, overseas and geopolitical uncertainty from the war in Ukraine. But there's one big standout, the dollar versus the Russian ruble. We're going to get into that later on. To discuss all of this, I'm joined now by Francesco Papadia. Francesco is former Director General for Market Operations at the European Central Bank. He's also currently a Senior Resident Fellow at the Bruegel think tank. Thank you very much indeed for being with us. The dollar is still dominating the investment markets around the world, the currency markets around the world, and yet the US economy has, over the last few years, because of the pandemic primarily, but other issues, been faltering. Why is it that the dollar is so popular still?
Well, the dollar has some characteristics that no other currency has. First of all, the most developed, sophisticated financial market in the world. Then an economy that, notwithstanding current issues, is still the most important economy in the world. Then beyond that, there is the strength of the US as a country, militarily, politically, that remains the most dominant country in the world. So it's no surprise that the dollar is still having this outsized importance in the currency market in the financial world.
One of the things I think that might surprise a lot of people is the fact that the ruble's been actually performing pretty well. It's up more than 30% against the dollar since March. And yet, as we know, the Russian economy is said to be struggling at the moment. What do you attribute that to?
Well, I don't think I would give a lot of weight to that. First of all, we don't know how liquid the market for the ruble is. We know that there are foreign exchange controls. And then it's a fact that imports of Russia, just because of sanctions, have gone down very, very sharply. And so the current account is in high surplus. So I would not take the strength of the ruble as a sign of strength of the underlying Russian economy.
We've heard stories where Saudi Arabia, for example, just recently said that it was going to do trade deals with China in renminbi as opposed to other currencies, which means, of course, that Saudi Arabia is building up a stockpile of renminbi. Does that in any way limit Saudi Arabia in terms of its ability to trade for other currencies, particularly against the dollar?
Well, I mean, there is no comparison between the renminbi and the dollar in terms of liquidity, in terms of underlying financial market. What I hear about different countries putting part of their reserves in renminbi, it's pilot. It's just to test the market, just to see how it works. There is nothing substantial. And the weight of the renminbi, for instance, in foreign reserves, is very limited. Of course, the renminbi is one of the currencies of the SDR, but this is more a political than an economic fact. There is a future for the renminbi, but just that, a future, nothing currently.
In terms of people's reliance on the dollar, how much of it is down to the fact that, as you were talking about before, the the structure that is built around the dollar is so strong that actually it would take a great deal to logistically unpick all of that in order to focus on another currency. Is that a legitimate argument? Is there, to some degree, an inertia for people wanting to have to go to the effort of detaching themselves from the dollar?
Well, there is inertia. I mean, the way it is called in economics, a network effect, which is the clearest case for telephone, for instance. I mean, there's no purpose of having a telephone if you have nobody on the other side of the line. And the more people you can reach with your telephone, the more the telephone is worth it. And that's the same with the dollar. I mean, there is a strong network effect and there is inertia. But this inertia, I would repeat, is based on strong foundations. I mean, the only country that could rival the dollar is the European Union, but is far behind in many aspects, including the sophistication of its financial market. And everybody else is way, way, way below.
What does surprise a lot of people, myself included, is the exposure that many countries around the world have to the dollar, particularly at times of crisis. When we see the level of antagonism, for example, we see between Russia and the US and China and the US, and yet the holdings of dollars and dollars by China and Russia still seem to be significant. Do you think, given recent world events, that countries like that are perhaps going to try and move away from the amount of dollars that they have in order not to expose themselves to the level of sanctions that the US can subsequently bring in?
Well, I think that there is a difference between Russia and China. I mean, the holding of dollars of China are incommensurably higher than the holding of dollars by Russia. So just this is a kind of a precision point. On your question, of course, there is the wish to move away from the dollar, but between the wish and the realization, there is the fact that no other currency, as I said, with the very partial exception of the euro, does have the same liquidity, the same ability to trade, the same underlying force of the financial market. So, yes, there is a wish to do it, but then when it comes to it, it's very difficult to do it. And for instance, for China in particular, differentiating the trillions of dollars of reserves into other currencies is very, very difficult. Also because any move of that kind would affect the value of their own reserves. So in a way, they are caught into this, and it's difficult to move away. Yes, so they will try, but it's difficult to do it.
I mentioned before you're a former Director General for Market Operations at the ECB. Given your level of experience, how do you see the currency markets and the dollar market particularly moving forward in the next few years? Are we going to see any significant changes to the way that dollars and other currencies are trading?
Well, the foreign exchange market is when it comes to large currencies. So euro, dollar, yen, dollar, sterling, euro. It's the most resilient, the most sophisticated market in the world. Of course, it doesn't have much of a structure in the sense that much of it just goes on bilateral deals. But it's a very strong market, and it's a market that never stopped functioning, even during the most deep crisis. The only competitor to that in terms of liquidity is the Treasury market of the United States. But we know that there have been some tremors in that market as well. So I would say that the foreign exchange market is the most resilient market in the global financial world. So there is a need to have more transparency into the market, and so I see that there could be moves in that direction. But I don't think that there will be dramatic changes in the way the major currencies are exchanged.
Francesco Papadia, we really appreciate you giving us the benefit of your expertise. Thank you very much indeed for joining us on Counting the Cost.
You're welcome.
So what's next for gold? Well, it's always been seen as a safe haven for investors. Many turn to the precious metal to protect their hard-earned savings when high inflation hits other investment products. But gold is denominated in dollars, so the strength of the greenback can have a significant impact on its price. Well, with us now is Jamil Ahmed. He's the Chief Investment Strategist for Middle East North Africa at the well-known international brokerage Al Pari. He's joining me now from London. Very good to have you with us. In your estimation, what's been happening to gold over the last year, say?
Thank you very much. Now, firstly, what's really pressured global financial assets this year, including US-denominated assets, is the strength of the greenback. As you pointed out, the greenback, the US dollar, has had its strongest year in roughly 20 years. And we haven't seen the pace of US interest rate increases from the US Federal Reserve be so aggressive in a generation. So essentially, the strength in the dollar has pushed all global assets lower, including US-denominated assets such as gold. So this is essentially what's happened to gold price. We still look on the longer term. Gold is roughly valued about $1,760 at our interview. This is an all-time high for gold, pretty much historically. However, gold prices have dropped as much as 20% based on the dollar strength. It is recovering now, but the strength in the dollar, which is likely still to remain supported, is what's made gold prices more cautious over the medium term.
Is this all down to the interest rate rises by the Fed, or are there other elements that could be playing into this as well?
Essentially, yes, the US interest rate rises have played into this, but if we say the global economy right now, let's say it's a large piece of cake. Now, this cake is divided into different pieces. We've got US interest rate increases, we've got inflation rates globally, we've got uncertainty with global energy prices. Of course, we're still seeing the drawbacks from the COVID pandemic and the impact of government borrowing and lockdowns. At the same point, we've got this very unfortunate conflict that's taken place in Eastern Europe. All of these factors altogether has been what's driven the dollar towards, its highest level in roughly 20 years. And we can't say it's any one isolated factor, but all of these factors combined have really influenced the dollar. At the same point, there is some hope that the dollar has peaked, which would be supportive for gold prospects and other global assets over the medium term as well.
So, Mr. Ahmed, in the event that interest rates do come down, are we likely to see people making an exodus from gold, and if so, where would they be likely to go, or do they stick with it?
Actually, we can say it's going to be the adverse with likelihood, because lower interest rate expectations, or at least signs that we've seen a peak in interest rates. Obviously, inflation is going to remain at a very sustained level. We know this. But any signs of a cool down could actually increase the appeal towards precious metals like gold. And this is because the pace of the US interest rate increases, which has obviously helped the dollar significantly this year, is likely to cool down. So if we see profit taken on the US dollar, we are more than likely to see a rebound in gold prospects. And in fact, this is a trend that we're starting to see over the past couple of weeks in global financial markets.
China and Australia and Russia are three of the main producers of gold in the world. What kind of impact does that demand have on their economies, if anything?
Well, if we look over the longer term, gold prices are still very high. $1,750 above this level would still be 10 years ago the highest level we've seen since the global financial crisis. In fact, what's happened is we saw the peak in the COVID pandemic when gold hit 2000. We also saw a rebound towards those levels at the beginning of the Russia-Ukraine war. And since then, we've seen a cool down. But generally speaking, over the longer term, gold prices are still strong. So this is still supported towards those economies and producers of gold. At the same time, obviously, and of course, if we do see a further rebound and an increase in gold valuation, this would be positive news for those producers also.
So far, it all seems very positive, but historically speaking, has there ever been a time when gold prices, or at least gold as an investment, has become really not worth it, and we've seen people moving away from it? And if so, what would be the signs that we should look for in the event that was likely to happen?
This is an excellent point, and one thing I'd point out here is that the global economic concerns and the potential crisis we're in now is completely different to the global financial crisis of 15 years ago. Now, 15 years ago, this was seen as like the birth of gold, something that really pushed gold prices higher. But at the same point then, interest rates globally were being pushed lower. Today, we're having a completely different set of forces that are pushing interest rates higher, which has been negative for gold prices. At the same time, we do think there's potential, as long as the uncertainty around the global economy doesn't continue to accelerate, of course, fingers crossed there, that we can see optimistic 2023 for gold.
If you had any spare cash lying around, would gold be your first option, or would you be looking at other possible investments as well?
Not necessarily, because you have to follow the trend. And very clearly, the trend has been your friend in 2022, and that friend has been the US dollar. In uncertain times, such as the very sensitive dynamics that are taking place right now in the global economy, the dollar is still your best friend. Hopefully, we see a bit of a change towards the global circumstances that might mean the dollar is not so much of your best friend, and we can start to bring other friends into the mix, such as gold.
Jamil Ahmed, we appreciate you being with us on Counting the Cost. Thank you very much indeed for your time, sir.
Thank you.
Well, it's not been a great year for cryptocurrencies, particularly the companies behind them. There still isn't much oversight of the market, and there are growing calls from regulators and even some crypto industry leaders for more controls. Bitcoin dominates the market. It surged by 300% at the start of the pandemic in 2020. Investors were looking for safety for economic volatility. Since then, high inflation, fuel shortages, and the war in Ukraine have caused a sell-off in perceived risky assets like stocks and cryptocurrencies. So the market's already volatile, and key crypto lenders have seen a slew of other setbacks for the industry, including withdrawal limits and the collapse of the crypto giant FTX, which have been causing more panic and more sell-offs. Well, to talk about those issues in more detail, let's bring in Hugh Roberts. He's Director of Research and Analytics at Quant Insight in London. Very good to have you with us. What's your assessment of how the industry has been working, say, over the last 12 months or so?
So a bit of background first, because Quant Insight, we come exclusively from a macro perspective. So when we're looking at an industry like crypto, we're really thinking, well, at what point does this kind of new, relatively new industry start to behave a bit more like a traditional financial asset? And the short answer there is for the first part of this year, it wasn't trading like a macro instrument. It wasn't like an equity or a commodity or any other risky asset. It was being driven by news that was specific to crypto. So it was, things like the merge, I guess, for Ethereum. But around early summertime, our models showed that actually all the major cryptocurrencies, Bitcoin, Ethereum, all moved into new macro regimes. And what we mean by that is that all of a sudden they behave much more like traditional financial markets. They care about inflation. They care about what the Fed is doing. They care about what sister asset classes, whether the dollar's strengthening, whether credit spreads are widening. And the main message from that was, in a period of high inflation and the Fed and other central banks hiking interest rates, that was negative for risky assets, including crypto. So the bear market was something that was entirely consistent with the kind of broad macro fundamental conditions that were prevailing.
How much is it also about faith? I don't understand a tremendous amount about cryptocurrency simply because, to me, it's incredibly technical. But to an outsider like me, it seems as though it is essentially based on the trust of the people that are creating the cryptocurrency that it's going to work, and the trust of people investing in it that it will work. But as soon as that trust is gone, then things start to come apart. How fragile is the market, would you say, even though it's at a macroeconomic stage that you're talking about?
Yeah, I think that's a very fair summary. I mean, in a way, that's the central tenet. This whole decentralization means that you remove a trusted kind of central counterparty. For traditional financial players, one of the big lessons from the 2008-2009 financial crisis was the importance of the counterparty. You and I could have a bet now on whether the dollar is going to get stronger this year, next year. And I might be right and you might be wrong. But if I fail as a counterparty, then you've got no one to actually pay out your winnings. So the importance of the trust of the counterparty is absolutely critical to the financial system. And as soon as you lose that trust, and that's obviously, we've had a few blows already, but the latest FTX saga has obviously just taken this to a whole new level. So I think your summary is very fair. And I think the short answer to your question is this has done untold damage to the industry as a whole. And you've got to think there will still be some diehards who will stick to the end. But anyone who is a marginal participant, you've got to think this is very scary news.
How much of this is down to the reliability, for want of a better phrase, of cryptocurrency itself? And how much of it now is about the efficient running of the companies which are supporting it? As, for example, the example that you used, FTX.
Yeah, absolutely. So I think the second part of that question is probably the most important part. I mean, there were just, from what we can tell, I'm not a specialist in the area of regulation or compliance, but the more news that emerged over November with regards to the FTX story suggests a complete absence of controls, that all the normal regulation and compliance checks that should be seen, the most basic one, segregation of accounts, people who are depositing money with FTX, it was in the contract that money should not be then lent onto the trading arm, and yet there was a backdoor siphoning that money out. So that is just about basic 101 company policy, company regulation. And if you destroy that, then it does a lot of damage reputationally. And yes, it's going to, again, to the earlier question, it's going to really damage trust.
Over the last year or so, we've seen or heard stories of a significant number of governments, from a local level up to a national level, investing in things like Bitcoin and other cryptocurrencies. There are countries which are bringing it or attempting to bring it in as legal tender. Is that a mistake, or do you think that actually they are doing the right thing as long as the companies running it are regulated?
Yeah, again, I have no degree of specialization in this area, but I would err towards that not being a mistake and actually being a good thing. A lot of the technology underpinning this, the blockchain, some of the advantages that it brings are clearly beneficial for individuals, for companies, for the broader system. But for it to operate completely outside of any control has to be a mistake, in my opinion. So I think having kind of central bank digital tokens, given that central banks have two main roles, typically, it varies country by country, but on the whole, central banks are there to fight inflation, keep inflation under control, and to oversee that country's financial system and ensure stability. So they have a vested interest in ensuring that there are no blow-ups on their watch. So central banks having involvement in this, in the crypto industry, to my mind, is almost inevitable.
Taking the wider view, and I appreciate, of course, that that's what you do at Quant Insight. If it gets to the stage where cryptocurrencies do become regulated in a similar way to, say, regular banks, if they become more exposed to the macroeconomics that we see around the world, what's the benefit of them compared to regular currencies, for example, in investments?
Well, apart from all the kind of technical advantages that it gives you in terms of efficiency, from a kind of a traditional financial market asset allocation perspective, if you like, the way that the traditional investor will think about things is, well, given where we are in the economic cycle, what's the best asset class to put my money in? So if we're in a kind of an economic boom, then you'll invest in risky assets like equities. Crypto is still going to be viewed as a risky asset, so it will tend to do well in good times. If we're in a stagflationary scenario, as many people fear, and maybe tipping over into a recession in 2023, then people will look for safe havens. Now, at one point, crypto was touted as a safe haven. I don't think anyone would really buy that argument today. But the other argument that gets rolled out with cryptocurrencies is an inflation hedge. And actually, we have the ability on our models to look at the independent relationship between an asset and all these various macro factors, including inflation. And Bitcoin does do a good job of tracking inflation expectations. So these relationships ebb and flow. That's the whole point of the business cycle and the way markets trade. But I can see advantages for crypto over and above the technological advantage that it brings, as potentially maybe an inflation hedge, for example.
Hugh Roberts is Director of Research and Analytics at Quant Insight in London. We appreciate you being with us, sir. Thank you very much indeed.
Thanks, Rob.
And that is our show for this week. But remember, you can get in touch with us via Twitter. Use the hashtag AJCTC when you do, or you can drop us an email. Our address is countingthecost@aljazeera.net. But there's more for you online at aljazeera.com/CTC. That's going to take you straight to our page, and it's got individual reports, links, and entire episodes for you to catch up on. And that's it for this edition of Counting the Cost. I'm Rob Matheson. From the whole team, thanks for joining us. The news on Al Jazeera is next.